Hope everybody's doing well. My name is Clayton. I'm the primary portfolio manager for Centurion Growth, where I manage assets for businesses, and I run and lead the live calls every single day for the Centurion Education Group multi-platform. We do financial literacy. We talk about business, credit, stock market, trading, crypto, real estate, everything. We talk about the whole 9 yards, but I trade live every single day in our Discord, CenturionGD.com. Join the Discord right at the top. So that's my background, a little bit about it. Josh, go ahead.
I'm Joshua Stauffenberg. I'm the Chief Operations Officer of Centurion Group. Now, what we're going to be doing today is we're going to be talking about some common misconceptions and some common questions that people have when dealing with covered calls. So we're going to go back and forth as if I were a new investor trying to ask these things from someone who has never seen the market from that kind of perspective. That way you guys can understand more so from a more experienced trader and fully understand what you're doing and how you can go about doing it in a safe, risk-free way. As Clayton mentioned earlier, we do have a Discord in which you cover these things live. It would be very beneficial to see that and implement it before money even touches the market. So that is one thing. Let's start. So I think the beginning point of this would be, what is a covered call? Can you talk to me about that?
Absolutely. So covered calls are utilizing options in the stock market, and I'm utilizing that option to protect my downside. So covered calls by nature are a bearish position.
Okay.
So what I'm doing is I'm choosing a strike price, and a strike price is another name for a theoretical share price of a stock. A strike price refers to an option, by the way. And I'm choosing a strike price that is above my average cost for shares that I purchase. So we'll go from A all the way through Z here. So if I want to deploy a covered call, the first thing I need is 100 shares of underlying stock or an ETF, whatever it may be. So I prefer to use ETFs. Some folks like to run covered calls on individual securities like Apple, Tesla, Google, and some of these companies have split recently, so it's a lot cheaper to buy 100 shares of those individual securities should you choose to run covered calls on them. So I buy my 100 shares of stock, and then I have the availability to sell covered calls. Now, every options contract is worth 100 shares of the stock, and then there's something called Greeks, which are variables involved, time decay, volatility, et cetera, right. Delta, theta, gamma, beta, vega. So different variables, different Greeks. But the bottom line is that covered calls are used to protect my downside as well as create additional cash flow, and sometimes so much so that I can buy shares of stock from the cash flow these covered calls produce so that I can grow bigger and bigger positions without me having to contribute any new cash to the market. So
that's a very interesting thing that you just mentioned, right? That idea of cash flow from these covered calls.
Absolutely.
And that leads into kind of the next question I have, which is how would I specifically profit off of these covered calls? How would I get that cash flow to actually move consistently month to month?
Great question. So let's say I choose an expiration, and every options contract expires at a given time. It could be 1 week, could be 1 day for some of those risky folks, or it could be multiple years in the future. Now, if you wanted to profit, let's say I get credited $100 for one covered call. That would be the price of that options contract when I sell the call. So in order to execute that trade, I need to sell the call, not buy it, sell it so that I'm credited the $100. The way that I profit is if the stock price draws down and falls after I deploy that covered call, or anytime in between the purchase or the sell of that covered call or the deployment of that covered call and its expiration. And when the share price of the stock drops, the covered call's options premium starts to fall as well because it's a call. So calls are traditionally bullish. So when the stock price drops, the bullish options fall along with the stock price. And that means on the other side of the aisle that puts are also appreciating in value. So puts are bearish, and when the stock price falls, puts go up. And the opposite is true with calls when the stock price goes up. But since selling calls is a bearish position, let's say I get credited for $100 and the share price drops.
Right.
So let's say the share price drops a few dollars, and then I see, oh my goodness, my contract is now worth $50.
Right.
I buy that contract back. That's a 50% return on the options contract, which is phenomenal. But you also have to consider how much cash you use to run that covered call, which is what the 100 share equivalent would be.
Right.
But I got credited 100. The options contract falls to 50. I buy it back. I keep the difference.
Sure.
So I keep that $50.
Yeah. No,
Goes right into my pocket.
That makes sense. Now, that's a very interesting thing that you've mentioned, and I kind of want to touch on it, right?
Okay.
So it's this idea of getting that capital, getting that premium, collecting the difference. Now, there has to be risk involved in some way, right? So can you walk me through what risks might occur and how to go about them, right? Like how to manage and work around those risks.
Absolutely. So the only way that I can lose a covered call is if I sell a call for a strike price that is below my average cost. So let me give you an example.
Sure.
So I buy X, Y, and Z stock at $20 a share, and I buy 100 shares. It costs me $2,000 out of pocket.
Sure.
And then that stock price falls to 16. And let's say I sell a covered call for $18 a share. That means I would lose money on that trade if I were to get exercised.
Okay.
Now, the way that I would get exercised is, let's say the stock price falls from 20 to 16. Again, my average cost is 20.
Mm-hmm.
And I sell an $18 strike, covered call.
Right.
If that share price goes above 18 and I get exercised at 18, I have to sell my shares at 18, which means I lose $2 per share. That's a loss.
Yes.
Right? So that's a realized loss. That's the only way that I would be able to lose those trades. Now, another potential problem, and this is by choice, right? So you have choices in regards to what you can do with these trades. Let's say that happens and I do not want to sell my shares for a loss. Another thing that I can do that potentially would be beneficial or potentially costly, you have to weigh out the numbers. I can buy back that 18 strike covered call for a loss, and then I can look a couple weeks out and roll that over to a new strike price that gives me more credit and covers the difference that I would have otherwise lost buying back that contract for a loss. So let's go back to the options example.
Sure, yeah.
So let's say I get credited for $100. And instead of the share price of the stock falling so that I would profit on the covered call, it rises.
Okay.
So that options contract is going to get more expensive. And if it goes in the money, it's going to have quite a bit more value attached to it because the delta is increasing.
Right.
So I would have to buy that contract back and I would pay more than what I got credited, which means money would come out of my account. Now, if I look 2 weeks out and I look for a higher strike price and a higher ceiling to let the stock price move a little bit more, I could potentially get credited for $200. So let's say my initial credit was $100. I had to buy it back for $150, but then I get credited for $200.
Mm-hmm.
And if I receive that full credit, I will still be profitable on that trade a couple weeks later.
Yeah, absolutely.
So there's definitely ways that you can absolutely mitigate that risk. And the way that I mitigate that risk is by going pretty far out of the money with my covered calls. Mm-hmm. So there's very little chance of me getting exercised. And I also have a multi-leg process so that if one leg's in danger, the other 3 to 4 to 5 will more than cover the weight.
Absolutely.
So that's how I mitigate there.
Sure. So now the idea comes up right now. I have this understanding of what a covered call is, how to implement it, what's required for it. Should I just go around buying, 100 shares of every other stock that I'd like to for individual securities and just start running? Like, so, where would the line be in your eyes?
Well, you know how opinionated I am with this question. So there are incredible companies that you can run covered calls on as long as you have faith in their long term. But my rule of thumb is I will never run covered calls on any ETF or any stock that I am not confident in the long term. So if I were to be stuck with those shares for 2, 3, 4 years, I believe in the underlying, or I won't run covered calls on it whatsoever. And I've gotten to a point where I've mitigated my risk so that I only use ETFs for covered calls and covered puts. I started out way back in the basements and in the basement that I used to live in when I moved out and that Josh and I used to work in.
Yep, I remember.
Where we would use individual securities for covered calls and covered puts. We'd use ticker symbols like Riot, Mara, Snapchat, just crap companies. Sorry. Just bad companies, right? So companies that just have no business being where they were, then they draw down, you lose money on the shares, you hold the underlying, and you get caught holding the bag. We don't want to do that, right? We don't want to do that at all. So for me personally, you guys can do whatever you want. You can do whatever you want. You want to run covered calls on Roku? Be my guest. Would I do it? Wouldn't touch it with a 500-foot pole. You guys can run covered calls on Tesla. Good luck. It's a volatile beast, and every time Elon walks into a new company with a sink, covered calls or covered puts could get blown out. So you got to be careful. So I really only use ETFs, and I use the S&P ETFs and the NASDAQ ETFs, and that's it.
Yeah.
I don't touch individual securities. They're too risky, and I don't believe in them long term.
I know, it's mainly for our viewers who would just say, oh, this is a great idea. Let's implement this right now to every single stock I've ever heard of.
Right.
Because, as a young trader, that's something you get caught up in.
And one other point is you have to look at the returns that you're able to generate for how much money you have to put into the holding you want, right? So if you are able to return X amount of dollars, but you have to put in 20X above what you're returning, maybe you have to put in 20X into the stock to buy the 100 shares, maybe it's not worth it. Maybe it's just not worth it to use that stock. For example, if you love Apple, I personally used to run covered calls on Apple because it made, the terrible dividend that Apple offers and all of its trillions of dollars made the terrible dividend, into a dividend on steroids. And I was actually making good money running covered calls on Apple. But Apple just doesn't produce the same returns as a double or triple leverage ETF would with covered calls, or a Tesla, for example. But you have to ask yourself, do I believe in the underlying that I'm putting 100 share value of capital into? That's the base question.
Right. It's the idea of accepting this stock as an asset moving forward and something that will appreciate in value.
Absolutely.
So that way you can actually believe in something while moving forward. So if you're down, like as we're seeing right now in a recessionary period, you're willing to say, oh, cool, this is at a discount, rather than, oh my God, I need to liquidate everything.
Let me touch on that for a second.
Please.
So when your underlying falls, right? We've been falling since January 2022. We're in 2022 right now. We're in November. We have been falling for a long time, and we're almost about to complete 2022. We've been falling for months. Now, the beauty is if I've been running covered calls for the entirety of the time where the market's been falling, I have all of this new cash that I can do one of the greatest strategies in the world, and it's called dollar cost averaging. It's when you have your average at $100 a share, and as that share price drops in the underlying stock or ETF, you get to buy more and bring your average cost down, which raises your profit, right? And I'm able to do that because I'm generating so much cash flow from the covered calls that I just get to buy more stock. And the beautiful thing is I have been running covered calls for that period of time. So I get this monthly cash flow month over month, and I can buy 100 share increments of some of these stocks over and over and over again. Sometimes I can buy 200, 300, 400 shares per week from my cash flow, but that's once the portfolios get a little bit bigger. So that's not necessarily where everybody starts, depending upon how much capital you have. But once you start doing cash flow, and let's say I did $2,000 in cash flow, I can buy a $20 per share stock right then and there. Boom. Another 100 shares, and the more 100 shares I buy, the more cash flow I get numerically per month. It might be the same percent returns, but I get more cash flow numerically per month, right? It's just like buying more investment properties in a real estate portfolio. The more properties you have, the more cash flow you have. Same thing with 100 share increments of stock running covered calls.
No, absolutely. Now, I think that kind of takes care of all my questions, or a lot of beginner questions. But if you specifically have questions, please, we implore you to come and join our Discord. It is very much free up until January 1st. Literally, just come on in. The link should be in the description below. Come check us out. Come listen to us talk live, and then ask as many questions as you want. We're more than happy to help you out as any way we can.
And we are carefully monitoring all of the platforms to make sure if you guys have questions, comments, concerns, that they're addressed as soon as humanly possible. And we have multiple platforms that we're on, so make sure that you follow, like, comment, and subscribe to all of the platforms if you'd like to continue seeing the valuable content that we are trying to provide to the public. And as always, our website is centuriongd.com. Please make sure you check that out. and join our Discord at the top so that you can work with us on a daily basis. And if you happen to want to work on the consulting side of the aisle, where I manage assets for business, feel free to reach out. I have full deliverables showing everything that I do and everything that our company offers to growing businesses. So I look forward to working with each and every one of you. Take care.